should you be 100% in stocks? Should you be having more diversification in there? Figure out what is the right thing for you to be doing, because like you'll get people who are probably like too heavily in stocks for where they should be. You'll also get people who are not heavily enough in stocks for where they should be. So I've got a whole chapter about figuring out like how much diversification you need, what level of risk is appropriate, and so like really getting your head around all that. And so you're taking on enough risk to get the return, but you also understand that however you slice it, there are going to be painful drawdowns. And I think that's something that, again, like we had 2022 where just like everything performed really badly all at the same time. And there are people who like pulled everything out of the markets at that point because it's, I can't take this, it's gone down too far. It went up by the same amount the previous year. They weren't complaining then, but it's just like, I think you need to either go like, I can deal with that. I know you, when the markets crashed in 2020, I think it was like, you put more in. It's like, great, the market's on sale. Yeah. And so like, if you are like that, that's your mentality, fantastic. But if it's not, if you might panic if things drop by 15%, then you need to be looking at that because the whole point of compounding is you just have to leave it.
Yeah, so when you said order, I was like, so are you saying we should tinker with it? Because you should just leave it, but you should just, and how often should you order? Because obviously tinkering with it's going to affect your returns and the compounding. Yeah. And how often should you be auditing?
I'd say it's mostly just like do it once and then leave it. So like it's maybe it's fine now, but I think a lot of people will be invested, but you also get a lot of people who they invested in an index fund, but the index fund is the US stock market, it's the S&P. Like maybe that's okay, but I'd look at that as like, if the whole purpose of this bucket is I get more diversification, I want to be diversified beyond the US, because like it's been the winner for the last however many decades. Is it going to continue being forever? Probably not. Will you be able to pick the next one? Probably not. So I would actually, if the whole point of that bucket is diversification, I'd want more diversification.
Yeah. And just before we move on from this, I think we can all sit here and go, just keep going. We interviewed a lady called Amy, and she was amazing. And she said that she understood all of that, but then when the crap hit the fan, she bottled it. Like she couldn't take it and she pulled out. Have you been through a major decline in asset values, be it property or stocks? And how did you weather that?
Yeah, so I had that in 2020, and then to a lesser extent in 2007, 2008. I didn't have as much back then, but it's still just like, it's still scary to see it happen. But I think that's why it's really easy to just go like, oh yeah, be greedy when others are fearful. Then when it happens, it's a different story. And so
I'm fearful.
Yeah, exactly. Yeah. So just like you absolutely can't like pull out at like when things are down. So you need to go, okay, like how much risk can I actually live with? And like the more you can educate yourself about it and have realistic expectations, the better. Like the market having a year when they're down 15% should not be a shock. It happens. And so it's like, you need to get to come to terms with that. Like, don't have the broker's app on your phone. If necessary, like give your password to someone else who you trust, but just like you need to kind of protect yourself from yourself when it comes to all that.
Having a realistic expectation of what returns looks like is crucial, because we quote the average return of say 10%, 9%. If you actually look at 100 years of returns, it's more likely that the year does a minus 20 than it does 10. Yeah. Because there's only actually 1 or 2 years that have hit the average.
Exactly.
It's more up 20, down 20, the swings there's volatility, right?
Yeah, that's normal, but I don't think it feels normal to people. And so you've just got to accept that. And again, it's about knowing yourself.
So is that part of the audit of saying, okay, at some point in this journey to retirement or to whenever I want to take out all this compounding, it will be down.
You're auditing yourself.
You're auditing yourself and your annual portfolio, or just really yourself and your mental approach to it?
All of it. So there's lots of different ways of putting together portfolios. So like one from quite a long time ago is called the permanent portfolio, and that's like ultra safe. So you've got like 25% in cash, 25% in gold, and the idea is it really limits your downside, but it limits your upside as well. And so you'll find that maybe if your normal portfolio would have made 9% before inflation over the years, that would only make you 6%. Over 30 years, that's a giant difference. Yeah. So you'd rather have 9. But then again, like maybe you wouldn't want to go that far in terms of reducing your risk. But so, well, that would probably, I think the worst year that portfolio has been down 9%, 11%, something like that. Like there's no way of getting lower than that. And so you need to be at least okay with that. And if you're going to go more aggressive than that, you need to be okay with bigger swings.
If you're a very anxious investor, that would be that would be good for you, because you're like, I know I can't take more than 9%, otherwise I'm going to sell it all. So at least this way I can leave it and let it run. So it depends on your appetite.
Exactly.
I think having this conversation is one of the most valuable things an investor can do, because it leads to other habits, such as getting out of default funds inside of pensions. You might go, well, actually, I don't mind a bit of risk. I understand that the market can drop 20%. And then you go look at your auto-enrollment pension fund and you go, this thing's like really cautious. And that movement out of the default into a more aggressive or risky fund can produce exceptionally more returns if markets perform like they have in the past.
Yeah, and in the other direction, because like if you're closer to actually wanting to live off those funds, then you can deal with a lot less risk.
You might want to get out of the fund that they're in and be more cautious. Yeah, exactly. I think that I don't think people watch your risk appetite, and no one actually sits down and works that out.
This was a clip from our interview with Rob Dix about myths about money. For the full episode, click right here.